Hello and welcome to the Investor Lab, the auditory epicenter for passionate people seeking a life of freedom, choice, and abundance. My name is Gabby.
And my name is Goose.
Hello, Goose.
Hey, how are you?
I'm great. How are you?
I'm fantastic.
Fantastic.
Yep.
What do we talk about today, Goose?
We talked about asset allocation. And more specifically, we talked about, we took it on a really interesting angle around thinking about capital allocation ratios. How do you think about your portfolio from a principles-based perspective? How do all of that kind of stuff. So we kind of touched on, how to think about where you're at in your portfolio, emotional fortitude, capital allocation, capital to debt ratios, time horizons, risk tolerance. Did I say emotional financial fortitude already?
Let's say it again. Emotional and financial fortitude.
Da! Da-da! So we kind of talked about all that kind of stuff. And I guess the big takeaway from this is really to try and help people think about their portfolio a little differently.
Yep.
This understanding what to buy is just as important as where and when. But also understanding how to think about what that will be allows you to step away from a tactics-based approach and will allow you to go further, faster, and more fulfilled than if you do it a different way. Did I miss anything, Gabby?
Yeah, so if you've ever gone through the process of trying to plan out your portfolio and thought about how do I not get stuck, or you may have heard stories about people getting stuck in real estate, and it's largely down to asset allocation and actually asset selection and being conscious of choosing the right asset for where you are in your portfolio and the assets and resources that you have, but also where you are as a human being in your life, and making sure that you pick the next asset that fits into that. And so people tend to get stuck when they actually choose the wrong thing. And so this is a really important episode, I think, for that. If you've ever thought about how do I make sure that I don't get stuck?
Absolutely. Yeah. And make sure you stick around to the end to get dating and hiring advice as well. So anyway, let's get stuck into it. Remember, of course, that if you like this, share it with a family member, friend, loved one, local stray dog,
boss,
cat.
Your cat.
Yep.
Cats love the show.
The attendant at the local burger store. Share it with anyone, really.
Barista.
This is barista worthy. Unless you're in Melbourne,
share
in which case nothing's worthy of a barista in Melbourne. Anyway, let's get stuck into it, Gabby. Okay. If you need any help, of course, make sure that you reach out to us at theinvestorlab.com.au or simply send us an email, hello@dashdot.com.au. Hello. Let's get stuck into it, guys. Cool. We look forward to seeing you on the inside. Hey, guys. Welcome back to the Investor Lab. You're with Goose and Gabby. Gabby.
Hello.
Hello.
How are you going?
I'm well, thank you. Long time no see.
I haven't seen you in so long.
What is...
so much Goose time.
People pay a lot of money for that. You're like
you're a hot commodity, and I'm the lucky one that gets staying out here long. We just giggle too much on this show.
I don't think there is such a thing as too much giggling. I think people take property way too seriously. There's not enough giggling in property, I think.
Giggle more, guys. There you go. That's the hot tip for this episode. More gigs. Get on the gigs.
For the benefit of the passionate and avid and committed listener, what have you been doing lately, Gabby?
What have I been doing? We went on a little holiday. Weekend away.
Yeah.
Beautiful. We went up to a place on the Hawkesbury River.
Yep.
And it was amazing. It was good to switch off for a couple of days.
Feeling recharged?
Yes. Feeling recharged. Back in the swing of things this week with a fresh perspective and feeling good.
Great. Awesome.
How are you?
I'm great.
What have you been up to? Did you also go on a weekend away?
Yes. The same things as you. But I've also been doing this other thing as well, right? So I've been like biohacking. There you go.
Without me.
I've been
just watching you start to glow from a distance.
Oh yeah. So
even faster.
I decided that my brain wasn't moving quick enough, so I thought I'd just find more nootropics to make it go faster. Mm-hmm. Vroom, engine's running. It's like vroom, we're cranking up. So no, I'm good.
Actually, we do have what's it called? Alpha brain.
Yeah, but I also got this other one, Qualia Minds, and it's so powerful and full of so many things that you have to take 7 caps just to get all the stuff. I mean, if that doesn't just scream value, I don't know what does.
Yes.
Anyway, what are we talking about today? We're not talking about going to the Hawkesbury River. We're not talking about superpowering your brain. That could be a really good episode to talk about biohacking, but
it would be.
What are we talking about today?
We're talking about asset allocation.
Asset allocation.
Always turns into a jingle. That's good.
It does, doesn't it?
Yes.
I don't know why.
It's just flow. Go
what do we mean by asset allocation? What are you talking about? What are
we talking about? So asset allocation, I personally think, is something that's really, I guess, under-discussed in property, and when we're thinking about a property portfolio, it's quite a common term. Again, we keep kind of referencing shares. It's quite a common term in terms of traditional assets in terms of shares and that kind of strategy. But it's a really important concept to consider and apply to real estate. And so it's essentially the idea of being strategic around selecting specific asset types and the way that they perform in order to get you closer to your goals. So it's, if you've ever gone through a process of trying to plan out your property portfolio, that's basically what it is. There's the saying of get you from where you are now to where you want to be. And so asset allocation is kind of the process of allocating particular asset types and their performance along the way to actually help you get to that goal. Yeah, does that make sense?
That makes perfect sense, and it was well articulated. I think it's exactly right. So, the way that what you're talking about is basically how do we distribute our capital in the most efficient way, in a way that is actually going to move us towards our goal and not away from it. That's what asset allocation is. How much money should go into which assets, and what types of assets would they go into, and why? And so there's kind of 3 key components, I think, to property success, right? There's buying the right property in the right place at the right time, or the what, where, and when, right? Mm-hmm. So the where can be good, but the when is important, right? So that's like suburb selection and market timing. Mm-hmm. But then once you've identified the right suburb at the right time, which is kind of that's kind of the science part, then you've got the art part, which is, okay, well, if we're in a suburb where there's 10,000 potential properties that we could buy, exactly what would we buy? Because not all properties are made equal. No two properties are the same. No two people are the same. No two journeys are the same. The where they are now and the where they want to be piece that you mentioned is different, literally different for everyone. Even though everyone wants the same ultimate outcome, time, money, freedom.
Houseboat
on the Hawkesbury River.
Yes.
Yeah. So far, I've spoken to 1,272 property investors, and every single one of them has said, my goal, Goose, is a houseboat on the Hawkesbury River.
Like clockwork.
Every single one. That is going to be one busy river once by the time we are done. You're just going to be able to walk right across it.
Come back.
Okay. Sorry. All right, cool. So, go on.
I just want to give some context. So this has kind of come up. Obviously, this is like a large part of the conversation that we have with clients, right?
Yeah.
But
it's the strategy piece.
Yeah. So, but I actually thought about this because you were telling me yesterday you had a conversation with someone who kind of runs a community of business owners, and you were talking together about how you could collaborate together and like what kind of value you could bring.
Yeah.
And his suggestion was that we as Dashdot as a business could kind of put forward, 3 deals a month?
Yeah, something like
into this kind of community or this portal or something. for his community members to, you know, pick and choose from this portal of deals and just have these deals kind of selected. And you were instantly like, that's not going to work. It doesn't work in our business model, but it's also like that is just not what serves people the most.
Totally. So the problem that he was trying to solve, and sorry to jump in there, the problem that he was trying to solve is he's got all these business owners. He's a business coach. He's got all these business owners that he works with, and they've all started making way more money, which is cool. But now they're asking the big, you know, the classic business owner question, well, now what, right? And so as a coach, he was going, hey, look, you know, let's start, you know, all these people are saying, I want to build wealth. And he's going, great, awesome. Let's, you know, quarterly plan. Let's, you know, buy some properties, whatever. And then at the end of the quarter, they catch up and they wouldn't have bought any properties. And so what this guy, this coach, he thought that the problem was that his clients didn't have enough deal flow. Right? Didn't have enough access to deals, to properties. And so he thought that the solution to the problem was more properties. He's like, hey, can we create this kind of situation where you can just send heaps of properties our way so our clients have deal flow? And I was like, deal flow is not the problem. Like, the last thing people need is more deal flow.
Yep.
Deal flow, that's a recipe for anxiety.
Yeah, for sure. And I think with that, it's because it's like it won't help people actually take action. You know, you get people more options and it increases anxiety and decreases action taking. But it's also not in their best interest, right? Because if you're just presenting these properties that, you know, totally vetted by our team and everything, like they on a piece of paper are amazing opportunities. Yeah. But someone may be in the complete wrong situation and have the complete wrong goals and where they're at in their journey to then go and buy that asset, and it completely throws them off their kind of journey to getting to where they're going. So it's really not about asset just volume for them. It's more about you need to be way more strategic.
Totally.
So this is kind of what this conversation is about.
Yeah, 100%, right? And so just as I said, the key to property success is right property, right place, right time. The number one reason that, you know, 93% of property investors never get past 2 properties and 74% never get past 1 is because they buy the wrong property in the wrong place at the wrong time.
Yep.
Right. And so asset selection really plays a massive role. So you could get the right suburb at the right time and buy the wrong asset and get stuck and never, ever get to your goal. So asset selection is you know in some way potentially the biggest piece in the whole pie. Yeah,
that's actually interesting to think about. Like, so many people that are like really into property and like just love. They're in all the forums, they're in all the groups and stuff, and everyone just kind of wants to know locations. Like, where are you buying right now? But again, that doesn't serve people because you can have the right location at the right time, but then go and buy completely the wrong asset in that area. Totally. And completely, you may as well have bought anywhere.
Yeah, and to your point, Gabby, that's actually the main reason that I don't like to talk about the suburbs that we're buying in.
Yep.
Because people will go, oh, I know the suburb now. Let's just go and buy anything in that suburb, and it's not, and it.
For sure, yeah.
You know, they're gonna get it wrong. You know,
and then they turn around and say, you told me to buy in this location, and it turned to shit. And
this property didn't perform well, and therefore, you know, it's like, you bought the wrong property. Okay, so
yes,
all right. So we've established that it's important to get the right property, but then how the big question is, how do we decide like at the asset allocation in our portfolio? Got any ideas?
No.
Well, guys, that's a wrap for today's episode.
Thank you for coming.
No, I think.
Well, okay, so I think it's from my perspective, right? I'm super high level, so I think it's about again, it's taking stock. It starts with like an audit of like where you are right now. What assets do you have? If you already have some property, if you have a certain amount of cash, if you have a certain amount of borrowing capacity or income or everything, where are you now? And then identifying both the time horizon, which is like how long do you want to keep doing this investing thing before you ultimately reach this goal? And like, what does that goal look like? Like, is it replace your income in terms of cash flow? Do you want to buy your dream home? All of this kind of...
Yeah, is it build a net wealth legacy for your kids? Because there's people who do that too. You know?
Yeah. And so that's kind of... from high level, that would be where I would imagine would be the first step. Is that correct?
Yeah, pretty much, right? So it's about resources, right? So there's a few things. It's about where you're trying to get to, how fast you want to get there, and what resources you've got to get there with, right? So understanding that is going to be massive, right? So, so it's kind of like time horizon and risk tolerance and all of that kind of stuff. And so there's a few things that come into it. Resources, which I want to talk about. I want to talk about capital to debt ratios. I want to talk about capital allocation between the different tiers in the apex progression. And I want to talk about emotional and financial fortitude, because they play a big piece in it. Because just because you've got a bunch of money doesn't mean that you should, it doesn't necessarily dictate, you should just do this because you have X dollars.
Yeah.
So the first thing I want to talk about, though, and I think this is a wildly misunderstood or underappreciated component in the whole strategy piece, it's capital to debt ratios, or capital efficiency distribution. So what that means in simple terms is, how do you think about the resources you've got? It's for the purposes of this part of the discussion, we're just going to talk about like cash, right? But it could be equity, or it could be whatever. We'll talk about cash or capital, right?
Yep.
So, let's say you've got $100,000, right? And you were to go and buy a $500,000 property. What's going to be your capital to debt ratio if you had an 80% loan to value ratio?
What were those numbers again?
$100,000 and a $500,000 property, right? So you're going to be buying a $500,000 property on an 80% loan to value ratio, but the capital to debt ratio is a 1 to 4.
1 to 4, yeah.
Yeah, so it's 1 to 4, right? And so what you really need to be thinking is, you need to be thinking around what is where is my optimal efficiency, right, of capital? So for example, if you were to go and buy a $500,000 property with $500,000 cash, I would argue that that's a very inefficient distribution of capital, because you're not using the benefits of leverage, right?
Yep.
Vice versa, if you were to say get a 100% LVR loan, for example, I would also say that would be inefficient in many ways, because your cost of debt would be quite high and your cash flow efficiency would be down as well. So then the question is, okay, well, based on different situations, what is the best capital distribution and what is the capital efficiency? And this is going to be on a case-by-case basis, right? So if we take a baseline and we say that, a good efficient use of capital is a 1 to 4 capital to debt ratio, that kind of gives us a baseline, right? So let's say you've got $200,000 of cash, right? And then you've got a 1 to 4 debt ratio. So that means you can get $800,000 of debt, right? That means you could buy $1 million worth of property. Okay.
Yep.
Now, understanding these ratios really plays a massive role in understanding how you should be thinking about your next property purchase. So for example, if you have if you've got $100,000, but you've got the ability to get, $2 million worth of debt, right? That's what a 1 to 18 something like that capital to debt ratio, right? So it's actually wholly inefficient, right? Because based on the amount of capital that you currently have, you could never actually use all of that debt.
Yeah.
Right? Yeah. So you're never going to be able to maximize your usage of debt as a resource. Okay. Now, vice versa, if you had $1 million in cash and $100,000 in borrowing capacity, then the biggest issue you've got is that your capital will be distributed inefficiently, right? So you've got debt inefficiency and then you've got capital inefficiency, right? So in those different scenarios, it's going to require that you think about your asset allocation in a very, very different way. And then you've got, somewhere that someone's in that's bang in the middle might be in the $200,000, $800,000, $200,000 in cash, $800,000 in available borrowing capacity. That's a $1 million in total asset acquisition power on an efficient 1 to 4 basis. So if you had $1 million of available purchasing power on an efficient, $200,000 cash, $800,000 of debt, you could then think about, okay, how do I want to split that up? Should I split that up into 1, 2, 3, or 4 properties? 4 properties at $250,000. 2 properties at $500,000, 3 properties at $333,000. Okay. Mm-hmm. Now, different properties are going to have different characteristics. Okay, but if we kind of look to the edges rather than the middle, and if we said, for example, someone had $1 million of available debt and $100,000 of available cash, then the goal for those guys, because, you know, on an 80% loan to value ratio, you're not going to be able to efficiently use all of your debt. You're not going to get the maximum usage of all of your debt. So you would want to think about, okay, maybe we should go 90% loan to value ratio so we can distribute our capital more widely, use more of the available debt, less of our available capital per purchase, with a focus on increasing the capital component of your portfolio, so i.e. capital growth, right? So what that would imply is you would have a strategy that is biased towards increasing your capital. What that might look like, for example, is buying single family owner occupier appeal homes, really close to town centers, potentially under market value. So the thrust of it is actually not going to be yield based. The thrust of it is going to be growth based. It's like, how do I maximize my capital? Now, if you've got a lot more available debt than you do have available capital, guess what? Yield plays a way smaller role in the whole piece. So if you've got 100 grand cash and, a couple of $1 million of borrowing capacity, and you've got a really good income and a good savings rate and all of that kind of stuff, then perhaps you could, be satisfied with a 5% yielding property if the value proposition was correct and if it served the function of increasing the capital within your portfolio. Vice versa, if you've got, $400,000 of available cash and $1 million of available debt, right? You might go, okay, well, in order to actually liquidate the amount of capital that I've got and to move that around in the right way, I'm going to need to focus on increasing my or extending my borrowing capacity through the usage of yield targeting, right? So in that situation, you might target something that is higher in cash flow and higher in yield, so potentially a duplex or a triplex or a unit block or something like that. Now, is that all kind of making sense, Gabby?
Yeah, it is. Yeah.
Do you have any thoughts on that?
I was just thinking, so it's largely starts with resources, right? Available resources to you, whether that's cash or income or equity or whatever your starting point is in terms of resources. And so you talked about, the strategy for the next purchase in terms of like, should you be looking for something? Obviously, you want the Holy Trinity, right? So you want in every purchase, you want something that is a combination of positive cash flow in a high growth location with that value add potential. But at certain points, you want to kind of lean into one of those points a little heavier than the other to keep your momentum going in your portfolio, right?
Totally. So just to that point, right? Yes, the Holy Trinity. You want cash flow growth and a value, some value add component, whether that be under market value, cosmetic renovation, strata subdivision, blah blah blah, etc. Right? But trying to get a 100% maximum in each of those areas is actually wholly inefficient as well.
Yep.
Right? So it's about balance. And the way that I like to think about that is, if you wanted to, if you had a bunch of stuff to do, you can go an inch in three directions, or you can go 3 inches in one direction, and you're going to go a lot further in that direction. So it's about balance, and it's about understanding what your portfolio needs the most, and it's about looking into the distance, right? So if you don't have much available debt, and then you lean into the wrong section of the Holy Trinity, you might end up running. If you said, "Oh, look, I know that I've only got enough borrowing capacity to buy one more property, and I'm just going to focus on something that's got a 3% yield because I think it's in a good growth location," you're going to be stuck for like the next 15 years, right?
Yeah, and that would be an example of that. Would be someone who, let's say they own their home, and maybe not outright, but they've got a lot of equity in their home, and perhaps their income is not very strong, so they've just got a normal level income, but they've got a lot of equity in their home. And we hear people kind of get advised that you need to go and do chunk deals, so you need to go and like do these subdivide and flip kind of deals when they've actually got no income. So the strategy should probably be more like look for something that's a stronger yield play, at least initially, so that you can liquidate the equity that you have, which you currently can't do with your income as it is.
Correct.
So going and doing chunk deals at that point in time, as a strategy, it works for certain people at certain points in their portfolio, but that for that particular person in that situation right then may not be the best strategy right now.
Yeah, 100%. And there's a few interesting parts to this, right? Because if you can understand capital to debt ratios and see them both as a resource, then you can start to make smarter decisions about about what to do next to make sure you don't get stuck, right?
Mm-hmm.
And there are different ways to think about it, right? You might do a deal specifically so that you can increase your capital to then sell it and then to pay down or to deleverage another part of your portfolio. That's something that you can do. So that's a situation where you might look for a chunk deal or just buy something that it's opportunistically under market value or whatever, even though it might tap you out on your borrowing capacity, but with the knowledge that you're going to sell it in 6 to 12 months, liquidate that capital and pump that back into your portfolio. That's one way to think about it.
Yep.
A much easier and better way to think about it is like, how do you just create a portfolio that can serve your needs and make sure that you're not going to be bumping against your headlines on either capital or debt. But there's another piece in all of this as well. You've got availability of assets in the marketplace, right? So you may have, and we'll get to emotional and financial fortitude as well. I think it's really, really important, right? So let's just say you're a first-time investor, right? And you've got, I don't know, $500,000 in cash because you've been whatever, you've got $500,000 in cash and you've got $1.5 million in debt, right? Available debt. When I talk about debt, I talk about it as a resource, not as like how much you owe.
Yep.
But you've got available, $1.5 million of available debt. An easy way to think about it would be like, okay, well, how do I just get the maximum efficiency for my capital, which might be like in some hypothetical scenario that you would buy a $2 million property. So you'd use 500,000 cash and 1.5 million in debt. And that property would also yield at, 7%. And it would also be in a growth location and all that kind of stuff. And if you could do that, that'd be great, right? But the problem with that is you've got a sensitivity risk. So if you happen to get it wrong, you've got single point sensitivity exposure to a specific market. And secondarily, those types of properties don't frequently exist. Okay. Mm-hmm. So I had a conversation last night with actually a client of ours who, for all intents and purposes, could go and buy a slightly more expensive property. However, based on where they're at in their portfolio, so we need to start by building a foundation. So we need to focus on building out growth assets. They've got like a 10-year time horizon that they're working towards. They're not short on cash flow, all good. Like they've got plenty of borrowing and all that kind of stuff. Now, the function that we've decided to do is to actually go, okay, well, let's build out the foundation level first. Let's make sure we're building a growth base. For the next 5 years, let's focus on accumulating capital. And then once we've built up that capital, we can then reallocate that capital into higher cash flow assets at a later point in time. And he said, oh, yeah, cool. So should we just go and look for some $600,000-$700,000 properties? And sounds good. However, you've actually got to think about what's actually available in the market, right? So at the moment, some of the best properties that are going to get the best returns are actually, in some markets are around the $350,000 price point. But that's not to say that we haven't also recently bought $850,000 properties. So you've really got to think about not just, okay, what is my price point? What is my, capital to debt ratios? But it's also where are the best deals? I mean, the way to think about that is like, it'd be awesome if you could buy Tesla shares at $1, but that time might have passed, right? So where are the value shares at the moment? Like, how can you make value-based trades rather than getting too hung up on a specific price point or a specific yield point? And also, if you can understand your capital to debt ratios, then you can start to think, okay, well, maybe in an ideal scenario, I'd be buying something that's $500,000 and 8% yield, but perhaps those kind of properties might not be available right now in the markets that are worth buying in right now. So then should I buy something else and what would that impact be? So then you can start to think, okay, well, what if I bought a $350,000 property that was at 6% yield on this one, but then what that might mean that for the next one, I need to buy, a $400,000 property with an 8% yield, right? So you can start to then think about the spices you're adding to the mix. And this is where portfolio structuring gets really interesting. Because if you can understand the macro ratios and how to think about all of that, then you can get much more opportunistic and strategic as well about what you're adding to your portfolio and why and when. It's like, it's like adding spices into a recipe.
Yeah, see, that's actually what's going to be like my next question was about if people have, let's say, 600,000 is their borrowing capacity, surely a lot of people would think that they should spend that on one asset, right? When you consider nationally, kind of median house prices are kind of exceeding that, and they're consistently going up, right? Many prices across the country are consistently going up. So people have this idea that, 600,000 might actually be cheap for a lot of people at the current point in time. So they would be thinking, okay, I'm just going to get one asset and max out my borrowing capacity on one asset. How do you actually decide whether you should do that on one asset, or you should break it into 2 or even 3 if it's a higher borrowing capacity? Like, how do you decide how many assets?
$600,000 example, because basically what you're saying is, should you buy 1 or 2? Should you buy 2 $300,000 properties or 1 $600,000 property?
Yeah. So even if we said there's $1 million borrowing capacity, right? So you have one.
Let's use the 600,000 because it's a good example, I reckon.
Okay. Well, I was gonna do 1 times 1 million versus 4 times 250.
Or 2 times 500.
Yes.
Yeah. Okay. Cool. Fine. So in that scenario, look, there's fixed and variable costs in every purchase, right? So on one level, it makes sense to buy the highest value, fewest number of properties possible. However, what that does is also expose you to risk. So, for example, if you bought a $1 million property in one location, firstly, if you're going to spend that kind of money, you still want to be getting good yields. You want to be getting 6 to 8% yields on that kind of a property, and that's going to be hard to find at that price point. So you'll have an issue on can you actually spend that much money on getting the right asset? Is that practical in the market?
Does that asset actually exist?
Yeah, does it really exist, and does it exist in the right place? I mean, you can spend $1 million and get an 8% yielding asset, but the question is it in the right place at the right time? That's the what, when, and where.
And you could also you could end up setting this unicorn property that you're looking for, but you could end up waiting 2 years to try and find that.
Exactly right. So you've got opportunity cost.
Yep.
So if you go to the other end of the extreme and say, well, all right, so from a risk management perspective, should I buy 10 properties at $100,000? Well, no, that'd be a really inefficient use of your capital, and based on a fixed and variable cost basis, your cash flow and your use of cash wouldn't be used as efficiently, right? However, let's just assume that this person is a first-time investor and they have never bought a property before. I would argue that the best use of capital would be to, in that scenario, to potentially buy 3 properties at $330,000. And the reason for that would be to build a diversified footprint on the ground, right? So multiple locations, exposure to multiple economic drivers, and to diversify their growth base, right? And then use that as a platform to increase the equity. Now, a lot of variables there, right? Like how much is, what's their, is their income likely to increase, all of that kind of stuff. But from there, if you bought assets if you've bought well, you're still going to have some headroom in terms of your borrowing capacity. And then after that, then you can start to refinance some of that equity out and focus on higher cash flow assets at a later date. So I would argue, and there's another way you could think about it too. You could say, look, why don't we do, $200,000 $300,000 properties so we would call those foundation ones, right? So, $300,000, 6% yield, under market value, all of that kind of stuff to firstly get a couple of runs on the board, build up the capital base, get a good diversified growth base, and then realistically, you're going to be, because if you're buying cash flow positive properties, you're going to be buying back some of your serviceability. So that means you're probably still going to have, more than the balance of $400,000 borrowing capacity. You'll probably have something closer to $500,000 or $600,000 borrowing capacity or purchasing power. So then you can redistribute the capital and debt to buy something else, which is going to complement those assets too. Does that kind of make sense?
Yeah, and I guess it kind of comes back to time horizon as well, right? Where if you've got 10 years to achieve your goals, or 15 or 20 years, however long you want, it's a different strategy to say, if someone had 2 years to get something done. We've got clients who are moving overseas in 2 years and they want to get everything kind of set up so that it's they're not financially free in 2 years, but they've got a good financial base.
Yeah. So
by
for
the time
those
they move, so
exactly,
it's a different strategy.
Totally, and that's really interesting, right? Because the goal for those guys is, how do we maximize the return on investment as fast as possible?
Yeah.
How do we get the maximum return in the shortest possible time, which includes a high leverage ratio, a high usage of debt, so that you get the maximum return per dollar spent, and the time horizon is quite short.
Yep.
Yeah.
So the risk tolerance is higher then.
Exactly. Yeah, exactly. And someone who's got a longer time horizon and a different capital structure, we might look at, say, like, let's just buy, 80% LVR and buy different types of assets for different reasons. Now it's going to come down to emotional fortitude as well, because some people want to go as fast as possible. Some people say, look, how fast can I do this? And they might be buying 4 or 5 properties in a year. And we've got lots of clients that are doing that. Okay. So, which is quite funny in an environment where, the standard property investor never gets past number 1 property. We've got clients that are buying anywhere between 3 and 5 properties in a year, which is pretty funny. However, speed is not for everyone, right? So some people might say, look, I'm happy for this to take the next 20 years, and I'm not, like, I'm good. This is long-term planning stuff. I'm happy with what I'm doing. And their cadence might be 1 a year for the next, 10 years. And we'll be looking at different types of assets in that scenario as well, because you've got different pay down timelines as well. And depending on whether you're doing principal and interest loans or interest only loans and all of that kind of stuff as well. Yep. So there are a lot of different ways to think about it. But I think that the most simplistic mental model, I think, is to look at the capital to debt ratios and work out where you're going to get stuck. Right? Because from there, you can think about your speed and you can go, look, I can go fast or I can go slow. That's cool. And from there, you can think about a lot of different things. But if you can understand those 2 aspects, you're going to be able to make, educated decisions around where to go. Because at the end of the day, everyone wants cash flow, right? So if you could just get stuff that has high yield every single purchase, you would. But the reality is that they're not super common. Otherwise, everyone would be doing it. So if you can understand, maybe you've got a ratio of 7 times debt to available capital, in which case, cool. It doesn't really matter if your yield is a little lower. 5%, 5.5%, cool. It's all good. Like, focus on building up the capital. And then later on, we can use that capital to then focus on things like, I don't know, 7, 8, 9% yielding, multi-family homes. But you've got a complexity analysis as well, which is where the emotional fortitude comes in, because sometimes, complexity is a real barrier, for people that have never bought before or who don't have, a lot of experience in buying properties and all of that kind of stuff. Adding things like trusts can create complexities because you've got all these additional requirements of things you need to do. Adding things like multifamily homes can actually be a little overwhelming because they've got multiple sets of tenants and, oh my God, how's that all going to work? And, you've got all these other kind of things to think about as well. And so I think it's as important to think about the emotional journey that people go on as much as the financial. And we've had loads of people that have come to us that have had plenty of capital and plenty of borrowing capacity, and we've said, let's just start small, because they need to get a couple of runs on the board first so they can build up their emotional fortitude before moving into more advanced stages in their portfolio.
Yeah, okay, so let's touch on that a bit more. So you say emotional and financial fortitude quite a bit. What do you mean by that, and how does that affect asset allocation?
Well, financial fortitude essentially is, what is your financial IQ as well as your financial capacity, right? Mm-hmm. Because you can have a lot of money, but also have a low financial IQ. And a situation like that might be, let's just say that you've never had any money and you've never really, money's never been a part of your life. You've never been a good saver or anything like that. But all of a sudden you get a big inheritance and you've got $1 million. You might not have a very high FIQ, right? FQ. So you've got to think about, okay, what actually is do you understand things like, capital allocation ratios, yields, cash on cash rate? Like, what's your understanding of the financial side of the transaction? Or is it just like, all right, buy houses, right? So it's really about assessing, financial understanding, financial fitness, like have you got a track record of being able to manage money properly, all that kind of stuff. That's kind of the financial fortitude side of things. It's not just about money, it's about your understanding of money as well. That's a big one. Cool. And then you've got emotional fortitude, right? So some people are more resilient than others. Some people have a higher risk tolerance than others. Some people like things when they're fast and fast paced, and other people like things when they're slow and easy. So if someone has a low tolerance for risk, doesn't want a lot of complexity, maybe has never gone on the journey before, is a little bit anxious about what's involved in property and how much, and oh my God, how does all this work and how do property managers work? And, if there's a degree of stress involved, I would say that's a low emotional fortitude, right? And that's okay because everyone starts somewhere, right? And then that's all good, right? So someone who has got a degree of stress around the process, I would say it's much more important to focus on assets which are not going to exacerbate that stress, right? Because you may buy a great property, but if you get to the other end of it and you've had this, damaging, challenging, stressful experience where you're emotionally scarred because it was all too fast, too quick, too complex, too hard, the likelihood is you're not going to buy any more properties. Well, certainly not for a long time. And then that's actually going to move you further away from your goal, not closer to it. Mm-hmm. And so just in the same way that, I might have a goal to run a marathon, but if I try and run a marathon, if I just go, great, all right, I've decided I'm going to run a marathon and then go and try and run 40, whatever Ks it is, I'm more likely to cause myself an injury. And also even if I did manage to complete it, I'm going to be in pain and I'm going to be hurting and I'm going to be like, screw this. I'm never running again. Running sucks. This is the worst thing I've ever done. Versus if I said, okay, cool, I would like to be able to run a marathon in 12 months. So what I'm going to do today is I'm going to start by running 1 kilometer, right? And then slowly building up to that, I would probably find that I have more enjoyment, more sense of achievement, and more sense of fulfillment along the way. And I think that this is the way to think about it. It's not about just going, how fast can I get into the highest ROI deal? It's about going, okay, what is actually going to satisfy me along the way? Because all of this is about the journey. The goal is cool, right? But the goal is not going to happen really, really fast. None of this is get rich quick kind of stuff. And so if you take let's say a 10-year time horizon with the whole thing, this is going to have to be something that you're going to enjoy. And you've got to think about that, not just about money as well. Does that kind of make sense?
It does. And I think it's way more important than people give it credit, like the role of emotions in property in this whole kind of world, because it really starts with self-awareness, right? It starts with like taking stock of not just literally like asset-wise, where are you at and resources, but where am I at in terms of like the realm of my life and what else do I have going on, and being really honest and clear with yourself about what I can take on right now. So if we go back to that example of someone who's got, maybe a lot of equity, but not a lot of income, and they're kind of thinking that I'll go and do some kind of chunk deal, or they might do might try to do a full renovation interstate, like they'll do it borderlessly and not go there and try and manage that on top of their whole life, what is currently happening. And so we actually see this happen to people where they will take that on as their first investment, kind of their first step into property investing. And that's the first thing that they try to do, because again, it's a good strategy and works for some people, but they're not thinking about how it fits into their whole life. And so they go through that experience and it is so stressful. It is so damaging just from the added stress that you end up leaving that experience. You might have a financial reward off the back of it when you actually finally finish it, but you are emotionally scarred from that experience, and you automatically make the assumption, well, this isn't for me. And you jump to property investing is really hard because you've accidentally done the wrong strategy for where you're at emotionally at that point in time.
Totally. It's kind of like dieting, right? Like if someone wants to go on a diet and, let's say they're like, hey, I'm too fat and I want to go on a diet. And then they go to an extreme and they go, I can only eat grapefruits. And they might lose a whole bunch of weight really, really fast, but it's not, it's not going to be something they're going to be able to stick with, and they're going to bounce back and they're going to get back to where they were. Right. Yeah. And so it's about going, okay, what's going to be sustainable? Like what's the sustainability context with this whole thing, right? It's a marathon, not a sprint, right? Yep. And to that degree, there's this really interesting dichotomy though. It's like, it's cool for it to take some time. So let's don't get too caught up in, should this be a 6% yield or a 6.2% yield? Like, given the time horizon, it doesn't really matter. Like, as long as you don't run out of debt and capital, and as long as you're managing your capital to debt ratios along the way, and your debt to income ratios along the way, you're all good. Like, you'll just keep on motoring, you just keep on humming, which is in fact, why we have such a high volume of clients that are buying 3 to 5 properties a year, because we pay really close attention to, okay, like what's the availability of debt and how we're going to manage that, right? So you can it's all good. Just focus on those things and you'll keep ticking through. But we've talked about things like time horizon as well. And there's this really interesting dichotomy where it's like, it's okay for just don't get too stressed about going too fast. But by the same token, if you've got depending on your time horizon, very broadly speaking, you want to divide your time horizon in half, and you want to accumulate the maximum volume of assets that you can within the first half of your time horizon. And then you basically want to do not much for the second half, right? If you really want to think about it in simplistic terms. So the way that I would explain that is, let's say you've got a 10-year time horizon and you're going to buy 10 properties in 10 years, right? If you could buy, and let's say that the goal was that you wanted to create the maximum amount of cash flow in your portfolio at 10 years, right? So let's say you're 30 now and you want to retire by 40, and to retire by 40, you need X amount of dollars in free cash flow. Would it make more sense to buy 10 properties, one every year for the next 10 years? Or would it make more sense to buy, 10 properties in the first, 5 years? But the answer is that it would make a lot more sense to buy 10 properties in the first 5 years. And that's got to do with usage of debt and, paying down of debt and increasing in rents and all of that kind of stuff. And so there is an argument that, the faster that you can build out your portfolio, the sooner you're going to get to your goal. However, that then just means that you need to understand what your goals are, because we can help people to do what they want to do really, really quickly. But that then goes back to the emotional fortitude piece. Because if you're 30 and you're like, look, I'm good and I've got a family and I'd actually rather this be not something that has to absorb a lot of my time, energy, effort, mindset, all of that kind of stuff. And I'm happy for us to just be really well set up by the time we're 50. And so you've got a 20-year time horizon. Sweet. Different journey. Different journey to someone who is, 50 and saying, I want to be done by the time I'm 55. And, then it's going to come down to capital allocation and all of that kind of stuff. But, you've really got to weigh up what are the goals, and remember that it's a journey,
Yeah, I think with that as well, like you were actually coaching one of our team the other day who's going through the process as a client himself at the moment. And he, we're talking about what's your goal? Like, what's the end goal and by when? And he said, I want 100 grand, 100 grand cash flow by the time I'm 30. He's 22, I think.
Yeah.
And so he was like, 100 grand cash flow by the time I'm 30. And you were like, dude, you don't need that.
Yeah, what are you going to do?
What are you going to do? Why? And he's like, oh, that sounds like a good goal, right? And it's like 30. And then you were like, you just don't.
Yeah.
It's a good goal to have, and it's a good, peg in the sand. Like, that's kind of what I'm aiming for. But you need to take stock and, again, be realistic about when I get to 30, is that going to be it for me? Am I, there and then that's, the end of the road? It's, realistically, I can have a lower cash flow goal by then and then actually enjoy the journey getting to there and then kind of keep going and do the next phase.
Exactly. There's a couple of other things that play into that as well. There's age, right?
Yes.
So at 22, his earning potential is not, he hasn't maximized his earning potential. So he's still young in his career, right? Yep. So the likelihood is that over the next, 8 years between 22 and 30, his pay is going to increase, his borrowing capacity is going to increase, all of these other things are going to change for him financially, right? And having a goal of my end game is in 8 years doesn't really set you up for how do I create the maximum amount of value, right? And the reality is most of us, barring an accident or illness, are going to live to 80 plus, right? So I'm currently 35, right? So I'm not even halfway through, right? And I can't even remember what happened when I was 5 years old, right? 30 years ago, I don't know. Right. So we've got these massive time horizons that we can actually work with. So really thinking about what that objective is and why is critically important. It's a little different. It is a little different if you're, 40 or, mid to late 40s or something. And not in any way implying that is old, right? But if you're in your mid to late 40s and you've worked for, let's say, 25 years full time, and then all of a sudden you realize that you haven't really set yourself up with enough super or the right, you set yourself up to have the right kind of retirement. And you're also then going, hang on a second, I might retire at 65 and then or 60, and then I'm going to live for another 20 odd years. What the hell's going to happen then? Right. Yeah. You may have a different sense of urgency, but understanding that time horizon is super important. And I think just back, getting granular on asset allocation thing, because we've talked about like the principles based approach. And so I think a lot of people might be like, but should I buy something that I can have a granny flat on, or should I buy something that is subdividable? And I really think it comes back to first principles thinking. And I had a really interesting discussion with a client the other day who came on board and said, hey, guys, I already know what I want, right? I want to buy something that I can either put a granny flat on or subdivide, and I want to get these kind of returns. And it was very, very pigeonholed. This price, these returns, this percent under market value, and these two specific potential ways of achieving that, granny flat or small development. And so what we actually did is we cooked it down to first principles. It's like, okay, well, what are you actually trying to achieve? He said, well, like everyone, he wants to be able to stop work and increase his capital, increase his cash flow, and do all that kind of stuff. I said, what's the time horizon? It was about 10 years. And I said, well, okay, well, the only two things that we need to think about is how do we increase our capital and how do we increase our cash flow, right? He said, yes. I said, great. So does it matter whether it's those specific tactics or not? And he was like, well, no, as long as I'm achieving those outcomes. I said, great, fantastic. And I think if we can cook that down to first principles thinking, it allows us to be more malleable in our approach. Because whilst some people might be like, well, I need to buy something and put a granny flat on it in order to get yield. What if the solution for you getting yield was actually to buy a duplex or a triplex? Somebody might say, well, I actually need to increase the capital in my portfolio. Therefore, I must buy something that I can subdivide the backyard off. And it's like, well, what if we could just buy something that was, I'm just making stuff up here, but what if we could buy something that was $50,000 under market value, and you could capture the capital in that way without the expense and without the time? And then vice versa, somebody might say, I want to do a small development. And you say, why? And it's like, well, because I want to get a 20% return on my capital over the next 18 months. And it's like, okay, well, if we could do that without you doing any small development, just purely by buying the right asset, right place, right time, right price, and you didn't have to have the risk, and you didn't have to have the opportunity cost, and you'd have to have all of that kind of stuff, would that be a better way of doing it? And the answer is always yes. So I think with all of this, we need to stay in a principles basis. Okay, so firstly, what are the available resources I've got? Right? How much capital have I got? How much debt have I got total? Because a lot of people make the mistake of going, I'll go get a pre-approval for $600,000. It's like, yeah, but how much? What is the total quantum?
Could you get? Yep.
What could you get? What could you get? Because that's how you're going to know where your limits are. What is the total potential available debt, regardless of how much capital you have? What is the total available capital, cash and equity and all of that kind of stuff? Okay. How are we going to combine those two things in the most efficient distribution of capital based on those metrics? And then what types of assets can we select that are going to complement your capital to debt ratios and move you systematically towards your goal? Ditch the tactics. Just ditch the tactics, because tactics change. Like we've had partners that have now come to us for their clients because they've said, hey, for the last 5 years, we've been saying that people need to do small developments to be able to build in the backyard because that's the only way that we knew how to build cash flow and capital. You guys seem to be able to do it without doing that, and actually we can't find those kind of deals anymore. It's like, yeah, well, we can do it a different way. And this is the thing. It's like you have to stay malleable to the market. So whilst, there might be a 6-month window where buying unit blocks is the perfect solution for everyone, but then that window might pass. In which case, then it might be an opportunity to look at stuff that can add a granny flat to for different reasons. Or potentially there's a market which is critically undervalued and you can buy lots of under market value properties because there's less competition there and you can capture money on the way in. So I think understanding the principles approach is much more important than getting caught up on, should I buy something that I can do a cosmetic renovation to, or should I buy something that I can do a strata subdivision to? These are all just little ways to achieve the ultimate goal of increasing your capital and increasing your cash flow.
Excellent.
Excelente. There was a lot of other stuff I reckon we could have talked about too, Gabby. So like use of leverage and impact of cost of debt and stuff. But maybe we should park some of that for another episode.
Yeah, let's do that.
Do you have any final thoughts? for the passionate and avid listener?
I was thinking about like principles based approach and not tactical, right? I was thinking about how it compares with dating, because I think it ultimately comes down to enjoying the journey, right? And being happy in what you are doing and being content with the journey as it is, and your place in it. And so when I think about dating, it's like when people
seeing someone?
I'm not. I'm seeing you. I'm seeing you. Come on.
Sorry.
The cat's out of the bag, guys. People know. No, I was thinking about dating, and I was thinking about how people that tend to have a really like finite idea of who this perfect person is that they want to start seeing, that they're going to try and find them. And they're really like tactical about like they look like this, they speak like this, they grew up here, and blah, 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 blah. And they've got this bucket list. And then so when they're, you know, I don't even know how people date anymore, but when they're on the prowl, when they're hunting, they've got this list of, you know, this very finite like pigeonhole of where they need to fit, otherwise they're not happy. And so that actually in turn means that they're not happy in the journey, because they're consistently not finding the exact person or the exact asset to fit that exact need that they think that they want. Whereas if you zoom out a lot and go, what do I actually want from this scenario? I want someone who I can enjoy spending time with and who love and cherishes me. And then you can zoom out from that, and then you can be happy because you're more likely to find someone that you have that connection with. And so you have that asset that's more principles based where you're not like super focused on the tactical of this is what I need. It's like the ultimate goal is that this, and then it's much easier to kind of find that.
Totally. And I was just thinking, as you were saying that, I was thinking about hiring. So we're doing a lot of hiring at the moment.
Yeah.
And you can like, it's the skills versus attributes discussion.
Yeah.
Right. So it's like if you could find someone who has the perfect skills for the job, right? However, if they have the wrong personality attributes, that's probably not going to be the right hire. They might be able to technically do the job, right? But you might not. They might not be an asset you want in your portfolio.
It's great. There's so many. It's true though.
Totally. So you know, and like, you know, just in the same way that maybe you should date, or maybe you should. I'm not giving any dating advice because I don't know, I'm out of the game. But I think Gabby, and he doesn't even know how people date anymore. I don't either.
No.
But so,
do people do that? Do people have fun?
I think they go on MySpace, don't they? Go looking for people on MySpace.
Probably.
Anyway, so like, you know, if you when you're hiring, you may find someone who's got the correct attributes, so personality, aptitude, all of that kind of stuff, but may lack the technical skills, and they could actually be the perfect fit for the role. And so if you think about your portfolio and your assets in terms of like attributes rather than skills, or, you know, principles rather than tactics, you're actually going to go a lot further and a lot faster and have a lot more fun.
There you go. Finish up with some dating and hiring analogies.
So if you're interested in dating some real estate and hiring some properties, then come and speak.
We've got a unit block just for you.
Okay, my question to you, Gabby, is: do you think that this has been helpful to anyone, or has this just been waffle?
A bit of both. No, I think I really hope it has, because as I kind of keep saying, I think it is really important to think about this kind of stuff, because it's so easy to hear a tactic and hear a location or hear some kind of strategy that people tell you should be doing, and then going down the wrong path and getting it wrong, and then having this scarred experience, and then opting out of the whole thing altogether, which is like it's a shame that happens, because people know that real estate works. Like it's a known asset class for increasing your wealth, and it's like it's so important to think about this kind of conversation of making the right steps for you and where you are at right now.
Yeah,
so
absolutely.
I really hope it has been valuable.
Yeah, totally. My one hope out of this is that people will start to think about their resources differently.
Yep.
And then start to think about those ratios, and then step back from the idea of thinking about tactics, because it doesn't really matter. It doesn't really matter what the tactics are, as long as you can focus on focusing on those two things. There's only two things that power a property portfolio and help you to achieve your goals, and that's capital. Well, there's three things: capital, cash flow, and debt. So if you can focus on what your balance is between all of those things, and step back from, should it be a blue house, a green house, a red house, a big house, a small house, 5 houses, 1 house. If you step back from that and look at the take a principles based approach to it, I think. I know for a fact that is the reason that we have such a high number of clients who are buying 3 to 5 properties in a year, when most other property investors don't get past 1. So there's got to be some truth to it. So, okay, guys, if you found this useful, make sure you let us know. If you thought that this was rubbish, make sure you let us know.
Too much giggling.
If you want dating advice, go somewhere else.
Don't come here.
Go to MySpace.
Run away.
But yeah, make sure if you have enjoyed this, make sure you share it with a friend, family member, or loved one. And if you haven't enjoyed this,
click a thumbs up wherever the thumbs are. Click that.
Subscribe, rate, review, thumbs up. Any other things?
Blow kisses in the wind. That's weird.
Okay, guys. See you on the next episode.
Bye.